Ladies and gentlemen, hope your day was good. My name is Dr. Robert Mugo. Welcome to Financial Literacy Simplified. Today I want us to learn about taxation, and the component I want us to learn about today is VAT, Value Added Tax. We shall do several series on VAT, and we shall start by asking ourselves, what is VAT? VAT is an indirect tax charged on individuals' spending. It is charged on provision of goods and services. The government adds value tax. Indirect tax means that it is a tax where the one who pays it is not necessarily the one who feels it. We normally talk about the tax incidence and the tax burden. For instance, the shopkeeper pays the VAT, but the one who feels the VAT is the consumer. VAT is a mechanism by which the government ensures that it collects revenue from ongoings in the country. You may find VAT has two aspects. There is the input tax. Input tax is VAT that is charged on your purchases up to the point where you get that item. And there is output tax. Output tax is the tax that is normally charged on your sales. I'll give an example. If that time you are consuming a cup of tea, that cup of tea started somewhere as artificial insemination semen. It was brought to a farmer. The farmer bought dairy meal. The farmer bought molasses. These items may have been charged VAT. The farmer, when they milked the cow, it took some services or some cost to transport that milk from the farmer's place either to the factory, whether it is Brookside or KCC or Githunguri Dairy, milk was transported there. Fuel that was used, there was some tax, VAT, value added. There was packaging, the papers that were used to package if it is milk in a sachet. There was tax that was paid. So when that milk gets to you, there is tax that has been paid every stage to have that milk in your place. If you are selling, though food items are not, we normally say they are not vatable. If you are selling this item, you would find at every stage it would attract also some VAT, value addition. Anytime you add value by giving a service or by processing, just doing anything, it calls for VAT. So input tax is that tax that is charged from the time good leaves its raw form to your business. output tax from your business. What value has been added? Maybe this milk from, if it is Githunguri dairy, it is now transported to the supermarket. In the supermarket, it is kept in a fridge. From supermarket, maybe somebody transports it to a restaurant. In a restaurant, so on. So we have input and output tax. We shall, in the coming lessons, we shall even do computations about how do you compute the input tax, how do you compute the output tax. VAT comes in 3 ways. There is what we call the standard rate. Currently in Kenya, the standard rate is at 16%. An item that is worth 100 will be sold when VAT is brought in or added, it will be sold at 116 because it is 16% of 100. There is what we call zero rating. Zero rating means it is charged VAT at 0%. And there is what we call exempt. An item that is exempt from VAT, it means there is no VAT. Remember, zero rated is 0%, exempt, there is no VAT. When we shall be doing the computations, we normally take the output tax less the input tax. The difference, if positive, you pay to the government as the VAT. If the difference is negative, you claim from the government. Either the government can refund you or can carry forward. The next VAT that you will pay will net off from that. A zero-rated item has output tax that is 0 and input tax that is whatever it was. So here you will claim from the government. An item that is exempt means it doesn't attract any VAT. So any cost that was incurred, whether it was value added tax or not, you will not be able to claim anything. Now for VAT, who can or who is supposed to engage in this VAT? Any business that is doing sales of at least 5 million and above is required to register for VAT. Any business which in the view of KRA should register, or maybe is dealing with petroleum products and so on, is required to register as VAT. For VAT, a business needs to file returns, to file and pay every 20th of the following month. If the VAT is for the month of April, by 20th of May, you are supposed to file. And if 20th of May is a holiday or a weekend, the day before that holiday. I said what is very key, a business with revenue or sales of at least 5 million. Here we are talking give or take around 17,000 shillings a day. So even very businesses that are considered very normal are required by the authority to register for VAT. I will stop at that. Let's continue learning about now VAT. Keep to my channel, YouTube and TikTok. Enjoy your day.